Hi, and welcome back to the WHVP podcast. In this episode of the podcast, the team sits down to discuss the current inflation environment, interest rate hikes by central banks, and the potential recession facing the US economy. Before we get into that topic, we will quickly discuss the celebration on August 1st of Swiss Independence Day or Swiss National Day. Now, let's get into it. All right, well, guys, welcome back to the WHVP podcast, our asset management talk, and I'm excited about this episode. There's a lot to talk about. I think we have a lot to get into. But first, I want to quickly open up talking about the Swiss National Day that we just had on Monday, which is the Swiss equivalent to Independence Day. How did you guys enjoy your Swiss National Day?
Well, we have to say this year we haven't really celebrated because we have been in France the week before for our summer vacation, and on August 1st we drove back because it's a bank holiday here, so our office was closed. So we used the extra day to extend our stay in the Provence for a little bit longer. But usually what we like to do is some fireworks, maybe a barbecue. I think it's quite similar to how you guys celebrate in the US, just summer day with family and friends and celebrating the joy and the privilege of living in the country that we were born in.
Yeah. And it was a beautiful day. It was over 90, 95 degrees or something. So it was a great day to celebrate. The only thing was this year you weren't allowed to use any fireworks because of the dry. But I mean, still you could do barbecue and enjoy the lakes. We have beautiful lakes in Switzerland. So
yeah,
that's what people do.
Yeah, we hung out with Judith's friends, my wife's friends, and it was good fun. I mean, just enjoying it. The sad thing was no fireworks, but there was a beautiful sunset.
Yeah.
Really gorgeous. And then where we were, there was also a rainbow. And then on our drive home, when it was night, there was lightning. So
oh wow,
got the fireworks in the end, just natural fireworks. So
Nice.
Yeah, that was cool.
Oh, that's very nice. Were you at the lake?
We were in a garden,
Okay.
a shade garden.
Yeah.
Yeah, it was really
very
nice.
nice.
Yeah, close to the lake, but not quite.
Yeah. Well, because you do live close to the lake.
Yeah, we live right next to Greifensee, but we went to a friend's garden. It's close to Greifensee as well, but not on the lake itself. So yeah, but it was good. It's good fun hanging out with people. A lot of babies in the friend circles now, so there's a lot to do.
Yeah.
Yeah, but it's cool. Yeah.
Yeah, I think it might also be interesting for our listeners to hear that the foundation of Switzerland was in 1291, so quite a while ago, and the story or the origin behind the day is that the three original cantons, which would be the equivalent to the states in the US, founded the country essentially on that day, and then other cantons joined, and now we have 26 cantons. But yeah, that's what we refer to when we celebrate the days, the Recession that happened over 780 or so years ago.
Yeah. When I was reading up on it, actually, I always thought it was just, the three cans coming together to make a bigger, more profitable, environment. But actually what I was reading is that they founded it to form a coalition to fight against their ruling bodies at that point, which were outsiders.
Yes, exactly.
So it even makes it deeper that we have sister republic between the United States and Switzerland, that the foundation came from a point of wanting to be independent. So that's really cool, really cool. All right, so let's jump into our topic. Today we're going to be talking about the topics that have been dominating, mainstream media, and I think even just in people's heads at the moment, and that's the rising inflation rate that we've been seeing in the US and even globally, as well as interest rates and the moves of central banks, and then the potential of recessions and what's going on in the US market, and how Switzerland kind of compares to that. So I'll just start off quickly with giving a few insights into inflation and what's going on in the US and Switzerland. I'm sure our listeners are quite aware of the inflation that's happening in the US. The last reported inflation number was 9.1%, I believe, with core inflation well above 5%, which is obviously much higher than they're forecasted, even when they were forecasting a month or two before. the releasing of the June information, they had forecast that's on like 8.6%, and they trumped it by 0.5 percentage point. I mean, sadly, it's not wonderful news by any means, because of how it affects people and their wealth. And yeah, it's an interesting time to be an American or be working with Americans and seeing that kind of effect on the wealth. To give I guess a different perspective also of what's happening in other countries, you can quickly talk about Switzerland, who currently has 3.4% of inflation. So Switzerland is experiencing inflation, and I would say considerably high inflation relative to Switzerland. However, they met their forecast. They actually beat their forecast. They had their forecast at 3.5%, so not by a huge percentage point, obviously, but we're still able to keep inflation under that 3.5 that had been forecasted. And I think that's something that's quite incredible about Switzerland when you look at the price increases for transportation, and that kind of wraps up the costs of energy for transportation, everything. Switzerland only increased by less than 2%. This year, which is quite interesting to see with what the global markets is happening. And in the States, you see gasoline prices have increased by nearly 60%, and I think the fuel oil has increased by 98% is what I was reading this morning. I mean, you just see these incredible price increases in the United States versus Switzerland. And I think that's kind of interesting to point out, to see how different economies act in a global market facing similar challenges and how they kind of handle them. So maybe Jamie, you could talk about interest rates and what they're doing and how I guess they kind of are being used to try to fight that inflation in their respective economies.
Yeah, of course. Raising inflation rates is one of the most popular or well-known measures that a central bank can take in any country to fight inflation, and that's what we see almost in all economies, or the vast majority of economies worldwide. Our audience and listeners are probably quite familiar with what the Fed is doing. I mean, last week they just announced another rate hike, and we just read an article recently that this year is probably going to be the most hikes that they ever do in recorded history, if they keep up the pace with what everyone's expecting for them to do in the second half of the year. I think, in my personal opinion, what can be said positively about how the US is going about is that they are very swift and very quite strong in their response in terms of interest rates. How they react to the situation. What is a little bit odd or a negative from my perspective would be how they go about talking about the problem, because I mean, we had this rate of the transitory inflation rate last year, and I think no one really believed it. I'm not sure if they believed it themselves. Maybe that they did, that would be another problem, I guess, but if they didn't, that's just a little bit problematic for me if people and investors are just being lied to keep everyone calm. Here in Switzerland, I think we have a bit of a more realistic approach. I think central banks, or the central bank that we have here, has been more honest and also more accurate in the forecasts that they have made. We now saw the first interest rate hike in Switzerland since 2007, so that is quite significant. Since 2015, we did have quite a large negative interest rate imposed on Swiss franc. It was negative 0.75%, and that's what we have for about 7 years now. So with the 50 bip rise that we saw earlier this year, we're now at negative 2.5%. And I think most people were somewhat taken aback with how fast and also how swift the central bank reacted to the inflation rate that we saw. Maybe a side note on the negative interest rates. With our clients, we never paid any negative interest rates because we have very good working relationship with banks, and usually they have thresholds from which amounts they start taking the rates. But the problem that Switzerland faces or has faced over the past decade or so is that our currency is so valuable and so sought after during times of turbulences and crisis, as we have also seen in the past 2 or 3 years. That the value really affects our export industry, and that the government is worried about the exportees not really having a line of business anymore if our currency is so strong. So what they did is somewhat artificially decreasing the value of the currency. And now we're almost at a flat rate again. So it'll be interesting to see how that plays out. I think it's also interesting to see how Switzerland compares to the Eurozone, because often I think when people talk about Europe, they don't really distinguish between the two, and oftentimes there's a lot of negative talk about Europe, at least recently, about the inflation rate in the Eurozone, about other difficulties in the Eurozone, about the lack of action in the Eurozone, but that's very different to what we are experiencing here in Switzerland. And not to do any Eurozone bashing, but I just think it's important for people who don't live in Europe to understand that Switzerland is very different in their currency management, and also how our economy works. So if you do read something about Europe, think about whether this is actually talking about Europe, the continent, or whether it is talking about the European Union, which is like this economic alliance that has a shared currency and all of that. So I think that's an important distinguishing factor, and that's probably the most important things to mention on inflation and interest rates. I'm not sure if I have forgotten about any of the most important talk points, or what do you think?
I think that's about it? I think we can maybe come back to discussing some of those things a bit later, but I think that's a really good overview of the US and Switzerland, and also bringing up the Eurozone and the European Union, the two different things, and the exclusion of Switzerland from those. I think that's often missed. Urs, maybe you can talk about, there's been a lot of talk in the media at the moment about a potential recession happening in the US. Is it a technical recession? The White House came out with some new definitions recently. Maybe you can talk about, kind of the economic environment, or the broad economic environment in both the US and Switzerland currently.
Yeah, I mean, what is very interesting to see is that not only the US, but also like the World Bank and the IMF, that they regularly have to update their forecast to lower levels when it comes to the global growth. And also in the US that there is always this, or in recent times, a lot of discussions of what is a recession. I mean, in the past it was clear, there was not that much of discussion about it. It was like 2 consecutive quarters of negative growth, you're in a technical recession. And I mean, it's clear that there are other parts which have to be considered and which play a role in how an economy is doing and how a country is doing. But at the moment, what we see is that it is a very political discussion. And it might be that it is because of the midterm elections in November or whatever. But we see some parallelities with what Jamie mentioned before of last year, when everyone said, it's the inflation is temporary. And then eventually they have to give in and say, okay, it's not, it's persistent. And now they say, it's not a real recession. We had 2 quarters of negative growth, but we still have low unemployment. But it is always like looking back, measuring things that are affected by the history, by the past. And in economy, you have indicators, you have lagging indicators, and you have leading indicators. And employment, for example, is a lagging indicator because it is a result of what you did in the past. But the leading indicator, for example, is what are the consumer staples, what are doing, and or how is the stock market doing. The stock market has a history of showing a recession coming in the past, and now we saw the first half of the year, which was for a long time was the first half of the year at the markets, and we see like consumers don't having that much of savings anymore, which they can spend because everything becomes more expensive. And then we have the companies who announced with that they will let people go, that they will reduce their stuff, and even if they already did, they will proceed to do so. And so from our perspective, it is very important also to look ahead, like as an entrepreneur, and look, okay, what do we expect from the future? And whether we are in a recession right now, that shouldn't be that much of a discussion. It should more be of a discussion, what do we expect? For what do we have to prepare ourselves?
Yeah, I think those are incredible points, especially talking about lagging indicators versus like current indicators, or the forecast of what's happening right now, not forecast, but what is happening now. I think that's a really, really good point to talk about, how we have to look at what's happening now, what's going to happen in the future, and what's been done in the past, so that we can see, okay, what might be the effects on the market. I think that's really good.
I just wanted to say that it is quite astonishing to me, because in no other industry you could just change the parameters while you're in the game. Like we can have a discussion on what a recession is, for sure. We can have an academic discussion about that. But you cannot, apparently you can, but I think you shouldn't, as a politician or as a Federal Reserve banker, just come out in the midst of a fight and then be like, oh, we're just going to move the goalposts here. That's not how it works. And I think politicians and bankers as well, they have a duty to be honest with their clients, because you can only set yourself up for success and prepare damage control if you know what's happening. And I was first, when I saw this whole inflation talk charade last year, I was really surprised that they were just doing it despite being called out by so many people. And now, not even a year later, they're doing the exact same thing with the recession definition, and it's just, I just personally find it weird. I'm not sure if it's like a cultural difference or if I'm just a little bit naive, but to me it is really problematic. And we have this word in German, which is called Salami-Taktik, which would probably, like a direct translation would be like the sausage tactic, where you just like cut one little piece after the other, so you don't really realize what is taken away. And I think that's what people are doing, or what the governments are doing, by just caving a little bit more every month, but not giving out the full information. And I mean, it's obvious what they're doing. I think most people see through what they're doing, and I don't really think it's helpful in the current situation.
And what is also important to mention is that a recession per se is not a bad thing. I mean, it's part of the economic cycle. Sometimes you grow, sometimes you cut back. I mean, that's how the economy works. You can't have like only sunshine your whole life. And that's also something I started missing a lot during the last couple of years, that whatever happened, there was a solution to it, to make things look great again. And that's just not how the world works.
No, and I think that's a really good point. I mean, when you talk about, if you go to any business school or any economic school or any finance school, you always learn about the business cycles. Mm-hmm. And I remember sitting in school learning about business cycles and how incredible they were, how they kind of function, and how they're not necessarily prototypical. They don't happen every once in a while, but there's rough parameters. And then at the time, I remember looking at the U.S. economy after 2009, the financial crisis and everything. I thought, man, we really haven't had a lot of business cycles in the past 10 to 12 years. And I thought, oh my goodness, what is, looking back, what are they doing that maybe changes that or makes that look different? And then you start looking into how they've been running their policies. And that's when you get into the expansionary policies that the U.S. has been running since, almost the JFK era of expansionary policies of printing large amounts of money, lowering taxes in general overall. There's always that fluctuation with different policies, but the M2 has been increasing incredibly since John F. Kennedy's presidency, and even more so when you look after the financial crisis. And even to this day, the M2, or the amount of currency, the M2 stands for it's a chart that covers the amount of currency being printed into the markets, being put into the markets, and in the U.S. that's still growing. And so they're raising interest rates to combat inflation, but they're still putting a lot of money in inflation into the circulation, and that's kind of contradictory to what they're trying to do with inflation rates, right, and interest rates to bring the inflation down, but they're still printing more money. It's slowing gradually, but it's the amount of money is in the market is very, very high.
I think with the economic cycles that you've mentioned, it's also important to note that we have almost a whole generation of people who are in their early 30s or younger who have never experienced like a big market crash, or at least not until this year, and have never really experienced high interest rates. And we saw that the psychological aspects of this conviction that you're invincible during the pandemic very strongly, and it will be very interesting to see how this is going to shape all those young retail investors and how it's going to change their attitude going forward, because a lot of the investment decisions that were made by a broad spectrum of retail investors were very highly driven by almost free or very cheap money, economic growth, and just this overall spoiledness of not knowing what it feels like to lose 25, 30, 40% of your investments. So I think it's, while always painful, and we fully acknowledge that, it's also, I think, a good teaching lesson for a lot of people who have not experienced any real investment crisis before, because it will change how they set up their portfolios and their investments long term, now that they know or have seen and experienced firsthand what it feels like to actually lose a significant amount of money. And I think, again, while it is painful and hurtful right now, it will probably be very helpful for them to learn that now, while they still have a time horizon of 30, 40 years until retirement, where they still have enough time to make up money. Whereas what we see with our older investors, not only have they less time or jobs to make up for the money, but they also know what it feels like to lose a substantial amount of their portfolio, which is often why they are a bit more, well, risk averse or a bit more cautious than the really young guys and girls who just don't really know what it feels like.
Yeah, and I think that's a big point when building a portfolio. Thinking as a young person, building a portfolio, I realize I have 40 years. You know, to build a portfolio before, maybe I have to touch that. And I think, you know, often what you learn is, you can hold a lot more risk, which is true. You can still hold risk and have a portfolio that's defensive, that's not going to grow maybe at the crazy growth rate that we've seen of, 35% a year if you're investing in certain indexes, but it's going to have a stable growth of, potentially 3 to 10%, year to year, and over 40 years that's going to add up. And if you don't have inflation crushing that, in countries like Switzerland where currency is not experiencing inflation, or even in the US, that has average inflation of about 2.5% each year over 10 years. What are you at? 20%, 25%? It's crazy. Look at those multiples where you look at other countries like Switzerland, again, who has had in the past 10 years up until this year periods of deflation and periods of low inflation. And so the economic growth that's happened is actually economic growth. And it's not affecting the value of that currency.
Absolutely. I think you bring up another very important point is when talking about how to beat inflation or how to get away from inflation, a lot of conversations that are not being held is that you can do that also by foreign currency investments, by investing your money into economies and currencies that experience less inflation or no inflation, and currencies that are gonna gain in value against the US dollar. And I mean, that's also something that we have talked about several times before. Yes, we did see the US dollar gain a lot of strength this year, mostly because of the rate hikes that we saw. But this is also an opportunity of getting your money or a part of your money out into other currencies and economies and profit from their growth that they are most likely going to gain back against the US dollar. I think that's one of the points that a lot of people are not thinking about when they think about how can they protect themselves against US dollar inflation. It's not just stock market investments or gold investments.
Yeah, I think there are a couple of reasons why the US dollar strengthened this year, but what is also interesting to see in this development is that these periods are mostly short-term periods where the US dollar is strong, because the US nor the world has any interest in a strong US dollar.
Yeah.
And there are forces that will try at least to bring the US dollar down again. And what we have also seen, I mean, you mentioned in the beginning last week, the Fed raised interest rates again, but owing to the expectations, the US dollar lost value. The Swiss franc gained quite a bit of value during the last 7 days, which is very interesting to see. And keep in mind, we are still in negative territory. We're still minus 0.25% interest rates. And there will be another decision coming up in September where we expect that the SNB, the Swiss National Bank, will increase interest rates further, which from our perspective will put more upwards pressure on the Swiss franc against the US dollar. And so I think that is a very good point. To diversify into other currencies can be a smart move, but it has to be very carefully executed, because as we have also seen this year, exchange pairs can move a lot within a short period of time.
Yeah, and that currencies, that exchange pairs, that they can be volatile as well.
Yeah.
You know, I think that's the way Jamie spoke about it, is currency investments. These are, to a certain extent, an investment. It's not just, okay, I have Swiss francs and I can't use them in the States. It's placing your money somewhere where you think it's going to be less affected by these market forces and eating away at that wealth. And I think those are really, really good points. Yeah, thank you guys. Really appreciate it. We're going to let the listeners know that this is going to be our last podcast for a while. For now, correct. For now. We're just going to be taking a break and brainstorming and thinking about how to move forward. We really appreciate all the listenership. It's been an absolute pleasure to be doing this for the time being. We're really looking forward to coming back. And thank you so much for supporting this podcast. Jamie, Urs, thank you so much for being a part of this and always sharing your incredibly insightful thoughts.
Thank you so much, Jess, for always preparing so well and for taking care of all the admin and like IT side of things. I'm very excited to get back to this maybe a little bit later this year or next year. But maybe if you want, while we are gone, check out our new image film. You can find it on YouTube under our WHVP site there. Should give you a little bit of an insight of who we are, how we do business, and of course we would love to hear your feedback. We'd love to hear what you think of it. Maybe leave a like or a comment, and then as usual you will continue to hear from us on all our social media sites, and you can also sign up for our newsletter if you want to stay in the loop of our economic thoughts and market analytics.
Yep, and we'll have that link in the description below in the video. Thanks again for joining us on this episode of the podcast. We hope you enjoyed it and found it informative. If you would like to learn more about WHVP and what we do and the services we offer, check us out at our website at whvp.ch. You can see this in the screen below. If you would like to follow us on any other social media channel, you can find us at YouTube, Instagram, Facebook, and LinkedIn by simply searching WHVP. As we mentioned in this podcast, this will be the last podcast for some time. However, we will be coming back, so stay tuned. Have a great rest of your week.